Welcome back to Investing Talk Podcast.
Today we're looking at SoFi Technologies.
As usual, before we start, subscribe, like, and comment to this video to support the show.
Okay, so let's set the scene.
Yeah, I want everyone to just stop what they're doing and look at the calendar. It is February 2026.
We're deep into the new year, and earnings season is delivering some serious fireworks.
And we really need to talk about what just happened with SoFi, because if you were watching the ticker yesterday, you saw something that, well, I think we're going to be debating for the rest of the year.
This was the big one. This was the Q4 2025 report every growth investor and fintech nerd has been waiting for.
Right, and here's why we have to talk about it. The headline number is absolutely staggering.
I mean, for the first time in the company's history, SoFi officially hit $1 billion quarter.
$1 billion. Adjusted net revenue came in at one point, 1.3 billion. Just let that sink in for a second.
It's a massive psychological barrier to break. It puts them in a completely different weight class.
And yet, and this is the mystery we have to solve today, if you looked at the stock market right after that news broke,
You'd think the world was ending.
you'd think the company just announced they were closing their doors. The stock didn't just drop, it completely melted down. A brutal pullback.
So you have this huge contradiction, a record-breaking blowout quarter on one side.
And a market that is absolutely punishing the stock on the other. It's the classic disconnect.
And it scares people. It really does.
Exactly. So the mission for today is simple. We need to figure out which signal is the true one. Is this sell-off a warning sign that the growth story is over?
Or is this the biggest buying opportunity of 2026 disguised as a total disaster? To answer that, we have to ignore the stock ticker for a bit.
You have to.
And actually pop the hood on the business. Because stock prices are emotional, but income statements, they usually tell the truth.
All right, I'm putting my skeptic hat on. Let's play data checker. I want to verify if this growth is actually real or if it's just some creative accounting.
Let's do it.
So we mentioned the $1 billion top line for Q4. That's up 37% year over year.
Which in the world of mature companies is just huge.
But is it sustainable?
Well, it's significant acceleration, and that's the key. Usually, as companies get bigger, growth slows down, right? The law of large numbers. SoFi is getting bigger and growing faster. That is extremely rare.
Okay, and looking at the full year for 2025, total revenue hit $3.6 billion. That's a 38% increase over the previous year.
Right.
But the past is the past. What about the future? Stock prices are all about what have you done for me lately or what will you do for me tomorrow?
So we check the forward guidance. This is what the company expects to do next. For Q1 of 2026, the quarter we're in right now, they're guiding for about $1.04 billion.
And for the full year, 2026.
They're projecting $4.655 billion.
And that number beat the consensus estimates from Wall Street analysts.
It did. They're raising the bar.
Okay, so purely on the growth trajectory, the top line looks incredibly healthy. But I want to push back a bit here.
Go for it.
In fintech, not all revenue is created equal. If I'm just lending money to risky borrowers, I can show a lot of revenue right up until they all default. Is this a house of cards?
That is the crucial distinction. And honestly, it's where most casual observers get SoFi totally wrong. You have lending revenue and you have fee-based revenue.
And lending is the risky stuff.
Super risky. It's tied to interest rates, the Fed, unemployment. It's cyclical. If the economy sneezes, lending revenue catches a cold.
And historically, SoFi was just a student loan company. That was their whole identity.
Exactly. But this report shows that identity has fundamentally shifted. They've been executing this strategy to move toward fee-based revenue.
So that's the stuff that looks more like a software company, subscriptions, interchange fees, platform fees.
Right, it's recurring. It's much stickier.
So how did they do on that front in this report?
Fee-based revenue surged 53%.
53.
53% to a record $443 million.
Whoa. Wait, so almost $500 million? I mean, nearly half their total revenue is now coming from these, lower risk sources.
Yeah, exactly. And that is the detail that the casual headlines might miss. This fundamentally changes the risk profile of the company.
How so?
It argues that they're becoming less of a volatile bank and more of a diversified financial ecosystem. When you value a company, fee-based revenue usually gets a much higher multiple because it's safer.
Ecosystem is the buzzword they always use, the Amazon of finance. But you can't be Amazon without customers.
And that's the other metric that just jumped out. Total members grew to 13.7 million. That is a 35% jump.
That is a lot of people. But here's the pushback I always hear, and frankly, it's the question I ask every time I look at a high-growth stock.
Go on.
Growth is great, revenue is awesome, but are they actually making any money? Or are they just burning cash to buy users? Is this community-adjusted EBITDA nonsense?
The short answer is yes, they are profitable. And definitively so. This wasn't a fluke. Q4 2025 marked their 9th consecutive profitable quarter.
Ninth. So this is a sustained trend now.
It is, yeah.
Okay, but let's define profitable. Are we talking about some weird adjusted number or actual money?
Both, actually. If we look at adjusted EBITDA, which is basically a proxy for operating cash flow, that rose 60% to $318 million.
And the margin.
A 31% margin.
31% is software-level territory. That is extremely healthy.
It is. But even if you go to the bottom line, GAAP net income, the real number accountants care about, it was $174 million.
What about EPS?
Earnings per share came in at 13 cents. That's up 160% year over year.
So they aren't just growing the top line, they're becoming way more efficient at turning that revenue into actual profit.
Right.
That efficiency piece is interesting. How are they doing that? Usually to grow members by 35%, you have to spend a fortune on marketing.
That brings us to the competitive moat. This is the secret sauce. It's why they can compete against the big legacy banks and, other fintechs like LendingClub.
It's all about the cross-sell.
Exactly, the financial supermarket idea. The stat that stood out to me was this. 40% of all new products opened in Q4 were taken by existing members.
Wait, let's break that down. Why is that number so important?
Think about the cost. If you're a bank, the hardest and most expensive thing is to find a new customer. You pay for Google Ads, TV spots.
Your customer acquisition cost, CAC.
Exactly, your CAC. But if that person is already in your app because they have a student loan and they just click a button to open a checking account, what did that cost you?
Basically zero. Maybe the cost of a push notification.
Right. If 40% of your sales are coming from people who are already in the building, your acquisition cost plummets. This is the ecosystem lock-in.
So you join for a loan, then you get a checking account, then maybe you start investing. It's like a gym that also sells you smoothies.
And once you have 3 or 4 products with them, you aren't leaving. It's too much of a hassle. It increases the lifetime value of every customer.
Plus their funding base is strong, right?
Look at the deposits.
Yeah.
They're sitting on $37.5 billion in deposits. That gives them a cheap way to fund their loans. It's a very stable foundation.
Okay, so let's recap the fundamental picture.
Mm-hmm.
We have record revenue, record members, 9 straight quarters of profit, and a machine that prints money by selling new things to old customers.
Fundamentally, the company looks stronger than it ever has.
So the business is booming, but if you looked at your brokerage app yesterday, you probably had a heart attack. We have to transition to the charts and talk about what on earth happened to the stock price.
The meltdown.
Yeah, because if the business is so good, why did the stock chart look like a horror movie?
It was just chaotic.
I was watching the price action right after the earnings release. In the pre-market, the hype was real. The stock hit a high of $26.33.
People were euphoric. Looked like it was going to the moon.
And then the opening bell rang.
And the selling started instantly.
It reversed all the way down to about $23.41 intraday. That is a massive swing.
From the pre-market high to the low, that's what, a 12% round-trip drop?
About that. And just on the day, a negative 5% move. For a company that just beat earnings, that feels like a slap in the face.
It feels personal, doesn't it? But we have to frame this correctly. I see this less as a fundamental rejection of the company.
Like, oh no, the business is broken.
Exactly. I see it more as a pullback before the breakout.
Explain that. Why would a breakout start with a sell-off? That sounds completely counterintuitive.
It's the classic buy the rumor, sell the news dynamic.
Yeah.
But it was amplified by where the stock was already sitting. The stock had run up a lot going into the report.
So expectations were just sky high.
Exactly. A lot of traders were sitting on, 20, 30% profits. When the good news hit, they used that liquidity to cash out. They sold because the news was out.
So it's a liquidity event. The good news provided enough buyers for the whales to dump their shares and take a profit.
Precisely. But here's the key. The execution of the business is still improving. The sell-off looks completely overdone relative to the actual performance.
The stock price went down, but the intrinsic value of the company went up.
That's how it looks.
Okay, so I'm looking at the chart for support levels now, because nobody wants to try and catch a falling knife. It looks like some psychological support is forming right around these current levels.
Around that 2341 mark.
Yeah, that makes sense. It's a previous consolidation zone. It's a floor where buyers have stepped in before.
And while the volatility is high, all that churn happening, the underlying flow seems bullish if momentum comes back.
If people realize, wait, this company just grew revenue 37% and the stock is cheaper than it was yesterday, those buyers could step back in.
And remember, the narrative we're seeing in the headlines, there's this talk of a strong revaluation catalyst in 2026. The market is starting to get it.
Okay, let's pivot and talk about that narrative. Let's look at market perception and sentiment. We ran the quantitative sentiment score on this.
And this is the tool that scrapes news feeds, social media, everything.
Right. And it spits out a number. The score, right now, it's neutral, a flat 0.
Which is fascinating, right, given all the drama we just described.
It is. A neutral score usually means nothing is happening. But clearly, something is happening. Why is the machine confused?
This is where you have to read between the lines. The algorithms see neutral because there's a conflict in the language.
How so?
You have headlines that use technically negative words. Meltdown, plunge, fearful. The algorithm sees those and registers negativity.
But the context of those headlines is totally different.
Exactly. The full headlines are things like back to earth after meltdown correction buying opportunity, or sell-off looks well overdone.
So the mood isn't actually bearish, it's more cautiously bullish.
Yes. It's acknowledging the fear in the market while pointing out that the fundamental strength is undeniable. It's like the market is afraid to be happy.
Waiting for permission to go higher.
A little bit.
I did notice one thing missing, though. We looked for institutional confirmation. Form 4 cluster buying, specific 13F accumulation.
So Form 4s are what insiders, like the CEO, file when they buy or sell. 13Fs are what the big hedge funds file.
And what did we see?
Crickets. No major cluster buying reported in the immediate aftermath yet. That doesn't mean it's not happening. There's a lag.
But we don't have that flashing neon sign of the CEO just bought $1 million worth of shares right now.
Not yet. But look at the catalyst calendar. We have Q1 2026 results coming up in late April, and the macro context is shifting.
Potential rate cuts.
Exactly. And a sector rotation into fintech. If rates come down, that favors SoFi's lending and deposit model. The environment's getting better for them, not worse.
Okay, we've been pretty positive. We have to do our job here. Let's pivot to the bear case. Why did the market really sell off? What's the risk we're missing?
It's the price for perfection problem.
Unpack that for us.
When a stock runs up 30, 40, 50% heading into earnings, the market has already priced in a great report. SoFi was trading at a premium valuation.
So when you're priced for perfection, good isn't good enough.
Even great sometimes isn't good enough. You need to be perfect. And if there's even a tiny hair on the report, or if the broader market is jittery,
you get a drop. It's a valuation reset. The investors are saying, okay, you did great, but we already paid you for that.
It's also market psychology. That fearful market response suggests investors are nervous about the whole sector.
Right.
And there's a specific risk here, too. The high yield risk.
Go on.
SoFi offers very high yields on their checking and savings accounts to attract deposits. That costs money if interest rates stay high or if they have to keep raising those payouts to compete.
It eats into their margins.
Yeah.
Because if they pay me 4.5% on my savings, they have to lend that money out at what, 7 or 8% to make a profit?
Exactly. It could curb loan demand while keeping their cost of funds high. It squeezes the spread.
But they are countering that with the fee-based revenue we talked about.
They are, and that's the hedge. That's why that 53% growth in fee revenue is so vital. It's the insurance policy. But the risk is still there.
I also want to touch on the rumor mill. We always see speculation. There's chatter about the tech platform revenue accelerating, maybe 11 to 20% growth in Galileo.
And the inevitable buzz about crypto and AI initiatives.
Right.
We have to be really careful there. Those are unconfirmed. Yes, the tech platform Galileo is a huge part of the long-term bullish thesis, and AI is the flavor of the decade. But right now, it's speculative.
So don't buy the stock because you think they're going to launch a SoFi GPT next week.
Exactly. Don't bank your investment thesis on unconfirmed product launches. Stick to the numbers we have. They're already good enough.
Fair warning. Okay, we've looked at it from all angles. It is time for the final assessment. Let's head to the verdict.
Based on everything we've analyzed, the shift to real profitability, the fee-based revenue explosion, the ecosystem, I'm giving this a bullish score of 8 out of 10.
An 8 out of 10, that's a high conviction score. Walk us through the investment thesis that gets you there, despite the stock dropping 5%.
It comes down to the transition. SoFi has successfully shifted from just being a lender to being a high-margin, sticky ecosystem. The Amazon of finance isn't just a slogan anymore.
The data proves it's happening.
35% member growth is outpacing almost everyone. And those deposit tailwinds provide safety. The post-earnings dip is the entry point.
A revaluation opportunity.
The market panicked, but the business executed perfectly. That divergence between price and value is where you make money.
So for the listener trying to figure out how to play this, what's the timeline?
I see two paths. If you're a trader, this sets up as a swing trade leading into Q1 earnings in April. You're betting on the gap filling back up to that $26 level.
And for the long-term investor?
This is a multi-year hold. You're holding to realize that projected 54% EPS growth. If they hit those targets, the stock is going to be significantly higher. You just have to stomach the volatility.
So, to summarize, the sell-off appears to be a psychological reaction, not a fundamental flaw.
Exactly. The business is growing, profits are up, and the ecosystem is working. The potential is real, and Q4 proved it.
That is a compelling case. It's rare to see a billion-dollar quarter treated with such skepticism.
But that might just be where the opportunity lies. The market hates uncertainty, but it loves results eventually.
We are going to leave it there. Something for you to chew on. If SoFi is winning the battle for the primary bank account relationship with millions of young, high-earning professionals, what does that mean for the legacy banks 5 years from now? If you're 25 and you can get everything on one app, why would you ever walk into a Wells Fargo branch? Are we watching a changing of the guard in real time?
That is a billion-dollar question.
Don't forget to subscribe, like, and comment to support the show. We will see you next time.